Okay, before we actually start looking in this chapter at the specific figures, which I promise I will get to, I'm not just teasing you with them, I want to give you some more background on exactly what it is we're trying to do, what we're looking for. If you look at this graph, you can see here returns that you would have on your portfolio, 10, 20, 30, 40, 50, 60%, and so forth. And here you can see drawdowns. A drawdown is from the peak to the trough of losses. So it might be minus 10, 20, 30, and so forth. Now, depending on the amount of risk that's taken, this is what generally happens to a portfolio. The more risk you take at this end, the more you can expect, of course, in terms of returns and drawdown. Now for risk, read the amount of money you put into a position. So if you put all your equity in, you're taking the most level of risk, and you can probably expect the biggest kinds of returns, but also the biggest drawdowns. If on the other side, you're taking less risk, well, you get very little return, very little drawdown. As can be seen here in orange, you're under trading. As can be seen here in red, for the risk you're taking, yes, you've got lucky once or twice, but you're actually over trading. The sweet spot is around here. That's the correct amount of equity that you should have on any particular trade. And that's why we've marked it along here. It's a middle ground, like I said before. But what is it? What is the amount? Now, in order to be able to answer that, I've got to take you through the second rule. Now, I know it sounds really complicated, long-winded, but it's very important as traders, as professional traders, we understand all of this and why and how things fit into place. So, let me take you to the next stage in terms of value at risk. Now, I've said that whenever we place a trade, we put a certain amount of money in. Okay, that's fine. But what happens in terms of our stop losses and our targets? I've said before, we set a particular stop loss and a target. Remember, we did that in earlier chapters. Well, with this, let's say you got in here at the point R when the price is roughly at 741. Where do you put your stop loss? You can't put it so tight that the stop loss will get hit. Remember, we looked at that before. Equally, you don't want to put it so far down that what happens is you end up losing a lot of money before you know you're wrong. You've got to put it at a level where you're comfortable that, yes, you've given the stock enough breathing space so it doesn't immediately get whipsawed, but not so much breathing space that you're completely wrong and you lose a lot of money. Fine. That's qualitative. I haven't given you figures. How do we work out figures? Well, this is where I'm talking about the example of too much breathing space. If you got in here and you gave it all this breathing space, that would be ridiculous. So what does it mean? Well, the balance is this. The stop loss should be set so no more than 3% of your total equity, i.e. all the money you have, let's say it's a £100,000 portfolio, no more than £3,000 would be lost on any one trade. Or, put it another way, if you have £10,000 in a portfolio, and let's say for argument's sake you divide that into 10 lots of £1,000 stocks, because of course you're not going to put all the money into one trade, you're going to divide it up. And let's say you divide it into 10 equal pockets for 10 trades. That means on any one trade, any one of these, you shouldn't lose more than 3% of £10,000, which is, well, it's £300. 3% of £10,000 is £300. So on any one trade with £1,000, you shouldn't lose more than £300. In other words, on any one trade of £1,000, you can afford to have a 30% stop loss. Why 30%? Because £300 is 30% of £1,000. Let me take you through that all over again. You should have a risk management policy where the stop loss should be no more than 3% of your total equity. In this case, the £10,000 portfolio, it should be no more than £300 lost on any one trade, maximum. Because you've only got a £10,000 portfolio, 3%. Why 3%? Well, some traders even say 1%. Actually, many professional traders will tell you 1%. Now, let's say it was 3% for argument's sake. You've got £10,000 in a portfolio and you divide that into 10 lots of £1,000 investments, then that means a 30% stop loss on any one trade, because £300 is 30% of £1,000. Fine. That's your stop loss. Of course, you don't have to wait until a 30% loss on a trade. You can have trading stops. You move the stop higher and higher and higher. Your exit point, if you're wrong, is what your stop loss is, but you can move it high, as we showed in other trades. It's more to do with technical analysis, is trailing stops. I won't deal with it here. Now, if that's 3%, we'll get back to the rules about how much money in any one trade in a second. The third rule of risk and money management is never add to a loser. That means no averaging or no pyramiding down. What do I mean by that? Well, what I mean is many traders will say, oh, look, the stock has fallen further. I know, I'll buy some more. I'll buy some more because my average entry price will drop and I'm more likely then to come out without a loss. Others will pyramid. Pyramid just means you don't put necessarily equal sums of money in. You might put half the amount of money in to reduce your average entry cost. Now, the reason we don't do this is because if you are doing it, then effectively what you're saying is, I was wrong, the price has fallen, and I'm willing to put even more money in to a stock where the price has actually dropped. That can't be right. What you're saying is, despite the fact that I'm losing more and more money, I want to own more and more of this stock. Despite the fact that the market is selling this stock for lower and lower prices, I want to own more of this stock. How does that possibly make any sense to anyone at all? Well, the answer is it doesn't. The only time you'd ever do that is if, to begin with, you never put the full amount in, and you always intended, as the price moved, to put more money in. That's the only time at which you would do that. Is that clear? Otherwise, you simply wouldn't do it at the earliest stage, unless it was all part of your original plan. Many traders do this because they mistake a win for profits. What they do is they think to themselves, oh, if I bought some at £10,000 and I buy some more now that it's halved in price at £5,000, the stock doesn't need to go all the way to £10,000 to make me a profit. It only needs to go up somewhere between 5 and 10,000 to make me a profit. And that's what they're trying to do. They're trying to break even. Well, profits in the market is not about breaking even. It is actually about how much money you make in total. It is not about the number of wins or losses. It is about how much money you make in total. And you're more likely to make more money if you just cut out of a loss instead of trying to fiddle around with it. The other issue is, if a stock is falling, do you really want to own more of it? And not only that, out of the entire universe of stocks, why is it that you have to be in this one stock? That doesn't make sense. Okay, so how much money should go into a trade? Well, like I said before, there's lots of different ways of looking at it. We saw that there's the 3% rule, which means that you would buy so much of a stock whereby you wouldn't lose more than 3% of your total equity. That gave you one answer. The other answer is that you look for an upside which was double the downside. If you couldn't find that upside, double the downside, you didn't make the trade. So now you know how much money to put in maximum, i.e. such that you don't lose more than 3% of your equity. You know where the risk-reward ratios are on a risk to money management. Let me show you another calculation for working out how much money should go into a trade. This is the formula. It looks very complicated. I know it's been on screen for quite a while, so you probably got quite scared of it initially, and now a little bit more relaxed. S equals ER over P minus X. Now you might be thinking, Alpesh has just come up with this. He's been drinking too much of the gin and tonic. Well, not so. I'm teetotal. I'm completely sober when I tell you this. But this isn't actually something which I've just plucked out of the air. This is actually a formula which many professional traders use. And it was developed by an American professional trader, not an academic, a professional trader. S equals ER over P minus X. Where S is the size of the trade. That's what we want to know. How much money should I put into a trade? That's what you're looking for. The way you calculate it is portfolio equity. What's your cash and holdings worth today? Let's say, for argument's sake, it's 100,000. So that would be E. You multiply it by R, maximum risk percentage, per trade. What is the maximum risk or percentage of risk we're willing to take per trade? That's R. I'll show you the maths on this in a second with an example. You divide that by, you work out P minus X. P is the entry price on the trade. X is the predetermined stop loss or exit price. So, if the entry price was 100 and the predetermined stop loss or exit was 90, that's 10 pence. And then you work out the portfolio size times the maximum risk size, and that gives you the size of the trade. It's actually a little bit like the previous one that I just showed you here anyway, which was, he says, going back and back and back. It was, if I can get back to it, a little bit like the 3% rule. Here it is, all the way down here. The 3% rule. It just helps you work out the maths on it. Well, let's have a look at it. Let's look at a specific example. If you have a total account of $100,000 and you're willing to risk 2% of your capital on any one trade, then let's say your system gives you a signal to buy ABC, $100 per share, and your system says a stop loss should be at $95. Entering this into the formula means that the trader should buy 400 shares, that is $40,000, because then the maximum loss would be $2,000, or 2% of her total equity. Yeah? You got 100,000, the most you're willing to lose is 2%, i.e. 2,000. That means if it does drop $5, the difference between the entry and the stop loss, then those $5 should represent total $2,000 of losses. So how many shares at $5 per loss per share would equal 2,000? Well, 400 shares would. That's why you buy 400 shares. That's not the way most amateur traders do the calculation. Most amateur traders will say, "Oh, I really like this stock. It was in the magazine. I know. I'll put, let me see. It's a sunny day today. I'll put $10,000 in it." That's how most people do it. This is probably one of the most important slides you're ever likely to see. I can't stress it enough. This is the end of the chapter. Pause, look at this, rewind the last bit. I assure you it is one of the most important things you will ever see.